Hello, hello, everyone. Welcome back to another episode of the Week in Charts. Charlie Bilello here, and with me today, Jamie Battmer once again. Jamie, welcome back to the Week in Charts.
Thanks, Charlie. Happy New Year, 2025. Halfway through the first month. Crazy.
Here we go. Ready?
Yeah.
Let's do it. We got a lot to talk about today. If you're watching this on YouTube, hit that subscribe button for more content just like it. And we have a lot of content to talk about today, Jamie. I hope you're ready for a lot of different topics here. The straw that broke the Fed's back. We got to talk about that inflation report we got this week and what that means for the Fed this year, where the new jobs are. And this has been a consistent theme throughout the last year in a few different areas. Living in the outlier, I want to talk about the NASDAQ 100's epic run here. It's one of the strongest runs we've ever seen over the past few years. Number 4, what would the deficit be in a year? I want to get your prediction there. Will we be able to cut the deficit at all? This year is a big question. Number 5, are bonds are still a good diversifier? This is probably the number one question, Jamie, that I'm getting from different advisors talking about bonds in the portfolio. What's the role going forward after the last few years? 6, we got some book recommendations, some winter reading. Good time to do some reading. You have a great book. I have a book recommendation. We'll discuss that. NFL playoff predictions. So we don't do market predictions, but we will make predictions for the playoffs. I want to see if you have any change of heart in your Chiefs, or you're going to stick with that going into this weekend. And then, of course, the Super Bowl. I want to hear your take there. And last but not least, we always end with something positive. That would be rising real wages, and they continue to move higher in small business optimism. You ready, Jamie?
All right, Charlie, let's do it.
Okay, here we go. The straw that broke the Fed's back. I'm being a little bit dramatic here,
Ooh,
but the
very
Fed
dramatic.
the Fed wanted to just keep cutting rates, right? They started with 50 basis points last September. We thought that was a little bit overly aggressive. Then they slowed, did 25 in November, 25 again in December, and they wanted to just keep cutting, right? Keep cutting back down. We know that Jerome Powell wants to ease. He wants to get in that helicopter and just literally throw money out from the sky. But he can't do it anymore, Jamie. And why can't he do it? Because the inflation numbers are really starting to move in the wrong direction. And now the market is saying, and we know that the Fed does exactly what the market is expecting. The market's saying literally no chance the Fed is going to cut rates again when it meets in January. So before we talk about the inflation numbers, what do you think for that January meeting? Do you think there's a chance there, 0.5%, or is the Fed really going to lose credibility if they continue to cut rates here?
Well, again, they need like any well thought out plan, you need to be able to respond as conditions update and act accordingly. You're talking about Powell wanting to drop money from the sky. I've never really seen that before, Charlie. Yeah, I didn't. What DB Cooper was like the last time that really happened, and no one ever found any of the money that he jumped out of that plane with, right? So, again, they thought they were going to raise lower rates 8 or 9 times. Wall Street did. It didn't happen. Now someone's thinking, well, they're not going to lower rates. Well, maybe they end up lowering it a lot. But I mean, the short term data with Fitch picking up saying they shouldn't, they could. They have a very long track record that almost I think you're more adherent to than I am of making the exact wrong decision at the exact wrong time. But the real point is they're humans just like us. Yes, they control short term interest rates, but their crystal ball is 100% as useless as ours is, and we'll see if they stick with what the dad tells them to do or some kind of bullheaded, nope, this is the path we're sticking to it no matter what. Very foolish, all walks of life.
Yeah, so their crystal ball coming into the year, if you look at the December projections there, was that they're going to cut rates another 50 basis points in 2025. But as we know, that depends on a million different variables, one of which we got an update on this week, the inflation rate, right? So if the inflation rate, which now has moved up to 2.9%, that's overall US CPI inflation, if that were to continue to move higher, Jamie, let's say go above 3%, start moving towards 4%, maybe we get no rate cuts at all this year, On the other hand, let's say it starts moving back down towards 2%. I think for sure you get at least one and probably a few more. And then you throw the economy into the mix as well, right? If there's a recession this year, they're likely to cut rates aggressively. No recession, unemployment rates stays low. Well, they have less of a reason to cut. But if you had to guess right now, and just being a guess, would you say that 50 basis points sounds about right? Do you think it's too low, too high, or just throw it all out because it's impossible to predict these things?
Guessing, in short run, I'd prefer to throw it all out. But if you're wanting for my opinion, in the very very short run, maybe they get it right a little bit more because it's right in front of you. But again, it needs to be data dependent. Who knows, right? Maybe tariffs ramp up inflation dramatically, or things continue to cool, like you said. You never know. I mean, we just had actually the fourth largest snowfall in the history of Kansas City last week. That'd be the equivalent of me being like, you know what, no matter what, I'm wearing sandals for the month of January. Well, then I deserve the frostbite to get on my feet if I'm sticking to wearing sandals no matter what. You never know what's going to happen. I'm wearing these weird glasses because the newest member of the Battmer family, Strudel Battmer, our new puppy, ate my regular glasses, right? If I was unwilling to change, because of conditions as they present themselves, be it dogs eating your glasses or snow on the ground or whatever economically, be in a much worse off position. And really, that's where these men and women hopefully will allow the uh, allow to drive their decision making.
Yeah, don't be dogmatic is what you're saying. Yeah, I think
Yeah.
we could all hope for that. And really my preference is, as you know, just keep an eye on inflation, make that more the priority because the other stuff is really outside the Fed's control. But if they're going to set interest rates to try to keep inflation at a certain level, then stick to that target level. And we haven't even got to 2% yet, and they're already, of course, easing policy. So if we look at core inflation here, Jamie, this is building up, right? This is what your people are feeling, that cumulative effect. And now we have 44 consecutive months above 3% for that core inflation, which excludes food and energy. That's the longest period of high inflation we've seen since the early 1990s. And then we have the breakdown here in terms of the report. And what we're seeing is, a mixture of things. We're seeing still some declines in gasoline and fuel oil, although it looks like the past month with the rises in commodity prices, that's not likely to be helpful to CPI going forward as it has been over the past few months with these declines. And then on the other side, still transportation costs very high and car insurance. We've talked about that being a big issue. And that shelter number, right, which we know is lagging, but still sitting there at 4.6%. Yes, moving down, but I think not as quickly as anyone expected. And that's far and away the biggest component for most people in their budget is what they spend on their housing costs. But if we look at the food issue, and that's something people talk about, and they love to talk about egg prices, Jamie. It's something they're buying every week, right? Similar to gas prices. They're feeling it, they see it every week. So it's more important to them, even if it's a small percentage of their income. They're noticing things like egg prices here, a dozen eggs, 4.15 on average for a dozen eggs. That's 65% higher than a year ago. So what's causing this? We know another bird flu outbreak, supply gets cut and you see prices go up. And obviously, this will likely come back down again when that goes away. But what do you say to people who are feeling still this pressure in terms of the food side and saying, inflation, yeah, the rate has come down, but I'm still feeling the pain at the grocery store, at the pump?
Yeah, well, I'm in that group. I'm feeling the pain. Having three young kids, see them on the wall behind me. And I'm the morning parent. Actually, that's completely wrong. My wife would kill me when she hears that because she's working her tail off too. I'm just the one that actually kind of usually does breakfast and amount of eggs, amount of bacon we eat. It's something you have to have. It's hitting you all the time. So it's really unfortunate. Obviously, people of lower socioeconomic means, it's a more pronounced excise tax on them, and it's terrible. But as you can see, these things ebb and flow. We had this huge spike before, everyone was talking about it. No one talked about it when it went back down. So there's always these dynamics
I
that
talked
that
about it, Jamie.
just not Nobel laureates like yourself. I just mean the commoners like
Yeah,
me,
that's right.
Charlie. But one thing, if you go back one slide again, what really again a really concerning thing longer term is like you said, shelter costs and home prices, and that's what we see. We've had it does just reinforce Creative Plan's core mandate, right? You're rewarded more for being an owner versus being a lender over the long run. I know we're going to talk about bonds, and they can serve a purpose absolutely in a portfolio, but it has to be specific to you. But owning stuff is where you get the value. And we've seen like, home prices go up, baby boomers not wanting to move out of their homes and just that inaffordability, interest rates higher, right? They're you know, you know, interest rates are twice as much as they were just a few years ago. And that is a real shame because that core mandated creative planning, there's a larger bump of the population that's not going to participate in that beautiful like ownership growth. You just can't. The average American only has money in two places, right? In their home and typically in their 401k. And they're both kind of forced savings, right? You oftentimes do things better, but the fact that it's not occurring for people because it's out of reach and then they're just spending more on rent, shelter prices going up, that's a real shame. And so, yes, while it's impacting people, it impacts people more that kind of on fixed budgets, people retired or people of lower socioeconomic means. It's a real shame that it's creating a complication for this natural way of accumulating wealth that a larger swath of the population is not being able to participate in, and that could have real ramifications down the road.
Yeah, so you're saying you have two different groups here that are at odds with each other. One group is benefiting somewhat from this inflation because it's also taken up asset prices. So their net worth has gone way up over the past few years when this cumulative inflation really exploded, right? So they haven't felt the pain as much, and those people tend to have higher incomes as well. So if you increase food prices by 25%, well, they're not feeling it as much because that's a smaller percentage of their income, right? Versus someone who doesn't own a lot of stocks and doesn't own their home, and they've seen this massive appreciation in these things, but they're not participating, but they're getting all of the pain of these necessary staples going up,
Yeah,
right? So you
it's a
have
shame.
that. But
Yeah.
in terms of policy, Jamie, who should the Fed be advocating for? Like, should we have a policy that tries to help everyone, or is it we going to continue to have a policy that really favors people who have existing debt, right? So if you create an inflationary environment, very good for people who have existing debt, right? You're just literally inflating that asset price, you're inflating people's incomes, and they have an existing amount of debt. It's tremendously good for them. It's good for people with asset prices, not good for that other camp. So what really should who should be the constituents that they're really focusing on here? Because it seems to me, if we look at the last 20 years and obviously the last few years, they're definitely biased towards keeping this inflation train going.
Yeah, I mean, hopefully the men and women atop the Fed are trying not to arbitrarily pick the winners and losers. There will inevitably be winners and losers based upon decisions. But again, I was actually lucky enough to learn, while I was completing my master's, some of these people were auditing teaching classes and again, you'd hope they seemed like wonderful people, the ones I was lucky enough to know or helped me write my dissertation. And they are, at least from my personal experience, they're trying to do collectively what they think is best, not taking care of something that rather, helps the fat cats or creates some distortion there. But every action, has a reaction. And again, I actually just hope they never play favorites and continue to kind of, again, maintain homeostasis. Unfortunately, it never works out equally for everyone. And hopefully that continues to rotate, right? So everyone can participate in some capacity instead of it being so tilted to one side as it has been recently.
Yeah, well said. And just have a sound money policy overall. Don't do what we did in 2020 and 2021 where we increased the money supply by 40%. Like that's going to have generational impacts. And picking and choosing is inevitable when you're doing things like that. So I have no doubt they have good intentions, Jamie, but the central planners in China had many good intentions as well, and we've seen that go wrong time and again, right? So they might want
Well,
the best for the economy. I'm not saying they're exactly the same, but I'm saying there shouldn't be a group of people, 10 people sitting in the room, pretending like they know what the interest rate should be or how much supply of money should be increased. I just think that's too much power in the hands of too few, and the market, the free market, would do a much better job of handling that. But that's a debate we could have for the entire show, and that's what makes it fun. You and I disagree on the purpose of the Fed and what their power should be. But I want to talk about the jobs market here, where the new jobs are coming from, what's the status of the labor market, because the economic expansion is really driven in large part by people having jobs, more jobs being created, obviously wages going up. We'll talk about that at the end of the show. The good news there, wages now continuing to outpace inflation. So that's really the bright side of things. But if we look at that recent employment report, we saw the number come in above expectations, 256,000 jobs. And I never like to look at just 1 month with this because, as we know, they're constantly revising these things. So it doesn't make much sense to focus on one number. But if we look at the trend here, 48 consecutive months now, so 4 straight years of positive jobs growth. That's tied for the second longest streak in history. So pretty good run there. And the breakdown in jobs, Jamie, it's been a consistent theme here over the past year. We're seeing it first and foremost in healthcare, which seems to have a perpetual shortage of workers in there with baby boomers aging and all the rest of it. Retail, leisure, and hospitality often at the top end, and then government jobs continue to expand as well. And then on the other side, you're seeing flat to no growth in many of the other areas of the economy. What do you make about the jobs picture? Do you think we're in a good place today in terms of the jobs market? And I guess the big question is on the unemployment side, we're at 4.1%. Are we going to see that increase, go back closer to the historical average, or can we kind of just tread water here at a good level?
well, again, who knows where it goes in the short run? But if you go back one slide, Charlie, I think it's really interesting. It part of why the Federal Reserve didn't cut rates as many times as Wall Street was prognosticating last year because the economy surprised to the upside. The economy surprised the upside because the driver of the economy, you and I as consumers, we're still spending healthily, and we're spending healthily because we have jobs. And so that's a great thing that someone that wants to. I know you're comparing us to Chinese, where someone wants to dictate their own terms and go out and get a job, but unfortunately, you have to work two jobs or something like that. There's opportunity out there right now, right? There's not these Hoovervilles for people that would be willing to do anything, and there's no jobs available. What I think is really interesting about this is it just kind of ties into the longer term narrative arc that's always there. If you would have what's this, yeah, it's healthcare, it's leisure, it's business services, tech type jobs. Go back like 100 years, 150 years, it would have been the same thing the last time there was innovation. All those jobs at the bottom, manufacturing, mining, logging, those would have been the ones that were expanding, right? As again, the industrial revolution was taking off, man, and then farming would have gone down, whatever. I don't know. Town criers. I'm not even sure exactly what that was. I feel like you would have made a great town crier, Charlie. Maybe that's what this
Absolutely.
is. This is a 21st century town crier. But the idea is, the type of the jobs market is ever evolving as the economy is evolving and what technologies are evolving. And again, it just reinforces, hopefully, there's always good jobs for people that are educated at all different levels. But it just reinforces the fact that knowledge is power, right? And as long as you're kind of putting yourself in the best position possible, that increases the likelihood of you staying kind of at the vanguard of what the evolutionary dynamics of the economy are that are going to drive where a lot of the jobs are coming from.
Yeah. So by the time your three kids are old enough to get jobs, like everything, all this whole picture will likely look much different, and there's no really way to predict how much different it will look in terms of what AI will do to everything. But safe to say that it's going to have a big impact on all of this. And I guess the big fear, which hasn't materialized, we know, but the big fear is always that it's technology is going to take away a lot of the jobs. But really it creates new jobs that people aren't currently anticipating. At least that's been the trend up until now. Will things change with robotics and with AI? And yeah, things are going to change massively. But is that going to mean, a dismal picture in terms of the
You know,
jobs market? I'm not convinced of that just yet.
the only guarantee is change, and again, using historical empirical data to determine this, like drives all the decision making at creative planning. Every innovation since the dawn of time has led to greater human success and more potential for prosperity. Could this time be different? Sure, but again, it would go against the evolutionary process since we started rolling around spherical rocks.
Yeah, well said. And if we look at the rate of growth here, though, Jamie, this is, I guess, what may be concerning to some people, or also the other side is they're saying, well, now this is just more of a normal labor market. We have 1.4% growth over the past year in terms of the total number of jobs, so that you could see just that has been decelerating that growth rate. We're about where we were pre-COVID now. And if you look at things like the quits rate, that's come way down, indicating a normalization in terms of people aren't quitting their jobs as much because they're not as confident they can go and find a new job. But then on the other side, you still have this wage growth number, 3.9%, well above the average of what we've seen over the past 30 years. So a lot of things moving in different directions. Overall, if we have to summarize 2024, the labor market still very strong, definitely loosening, but doesn't appear to be at a stage yet where companies are doing anything close to massive layoffs. We're just seeing kind of a normalization and transition and following those real boom years in terms of tech hiring in 2020, 2021. It's more of just kind of a mean reversion, these companies right sizing for the future. Any more thoughts you have there on the labor market?
Yep, that was perfect, Charlie.
All right, beautiful. Let's go to living in the outlier. We always talk about
Mm.
outlier periods and markets, and now we're living in one of them. If we look at the NASDAQ 100 here, I'm showing you the chart versus the 200-day moving average. And as you can see here, we haven't closed below it since March 2023, so almost 2 years. And if we look at this table here, it goes back to 1986, the NASDAQ 100. This is now the second longest streak in history for the NASDAQ 100 without a close below the 200-day. The number one there was that epic run from the middle of 2016 until the October 2018, and that during that period you had the 27 year where I think the market was up every single month that year. So you had just an unbelievably smooth ride during that period. But second longest streak in history, pretty incredible. Jamie, what do you make of when you're in this outlier type of period? What's the message that investors should take away from this?
The outlier periods happen, right? Just like dramatic pullbacks happen. For anyone that says, "Man, I wish I would have invested in Amazon when I thought it was a great idea to buy my books from there instead of having to go somewhere." Well, great for you, great returns. You would have had to have essentially survived a 97% market decline in 2000. And if you're able to do that, then great. And so the point is that keep calm and carry on. Yeah, it's been a long run, but right before this, Charlie, I mean, how dramatically did big tech underperform in 2022? It just reinforces, yeah, this is long, but people are thinking, oh wow, this has been going on for a long time. No, we actually had the worst stock market since the global financial crisis 2008, only a couple of years ago, and by some measurements, the worst bond market ever. And people forget that. People forget that real fast. And yeah, it's an outlier event, but outlier events happen. 100-year storms happen every 6, 7 years, it seems like. Tragedy a lot of people are dealing with in the United States right now. It's easy for my climactic 100-year storm complaint to be a little bit of snow compared to what some of our friends and colleagues are dealing with out west. But outliers happen. They're not nearly as outlier as people think, even though this is a historically strong run. But again, we're at the infancy of the second most significant, leap forward since, the Industrial Revolution by a lot of capacity. So that's driving a lot of exuberance behind it. If it's irrational, if justified, who knows yet? The future forever remains unwritten, but you got to keep calm and carry on. Have these things be a part of your portfolio. Absolutely don't chase it now, but don't run from it like unfortunately a lot of people did when the stuff collapsed in 2000 or 2001.
Yeah. So notable, I would say that a bunch of these periods here have occurred in the last 10, 11 years. Looking at 2016 to 2018, 2013, 2014, 2020 to 2022, and then you go one down from there and you have the tech boom, right? So it's just very interesting that, yeah, by itself, I would say doesn't mean very much. But if you look at the last 10 years, and we know this kind of obviously looking at the investment returns, but Jamie, to see like one ridiculously long trend after another, yeah, we did have the 2020 crash. We did have 2022. I don't want to minimize that, but outside of those periods, it's been almost smooth sailing for investors, which is kind of unusual. My takeaway is when you have these types of periods, just be thankful that they're going on. Know that it's not always this easy as an investor, and it's only a matter of time before you're tested again. So just make sure in your portfolio you can handle that next period of risk. And the best time to kind of think about it is during this period of relative calm.
Yeah, I mean, one thing here, yeah, the fifth column, right, 98 to 2000, like the true infancy of the digital age, right? The
Yeah.
old Cisco and all that is great. So a lot of recent, I know you said it's been a long time. Where we measure success in success needs to be measured in decades, not even a decade. That 98 to 2000 run, you didn't recover to where you were for that entire 15-year period between, right?
Yep.
And so it feels like we've had a great time, but for any halfway seasoned investor, anyone that's off their parents' insurance, right? You experience a very, very prolonged period of nothing but negative relative returns, even for this extraordinary asset class. And so it comes again, these outlier events happen. It's great that it's happening to the positive side. Outlier events happen to the negative side. And yeah, 30% downturns stink, but we've had two of them in the last 15 years, right? I hope every single person on this call, has more than that time horizon ahead of them. So, it's outliers are the norm, not truly just some outlier random event, in my opinion.
Okay, so I want to go to the other big question for this year. We're getting obviously the tech question we always get, but in terms of U.S. domination, right, we're at 65% now of the global equity markets here in terms of U.S. You could see Japan all the way down there is number two at 5.6%, not even close. And then if you break this out in terms of the U.S., I just showing you here the Magnificent Seven versus everyone else except for the US, the biggest weightings here. And kind of remarkable that after Japan, Apple, Nvidia, and Microsoft, all with market caps above 3 trillion, they're all above every other country by themselves. Every other country, just thinking about that, letting that sink in to tell you how enormous these companies and obviously enormously profitable, all three of them as well, but just kind of remarkable. And then after that, you have Amazon and Google right up there as well, and then down here, Meta and Tesla. When you see a chart like this, Jamie, we know these are the biggest holdings for everyone who's holding a diversified index portfolio. We know the valuations on these companies are not cheap across the board. Is this type of stat worrying to you? Is it just a function of the dominance of these seven companies in terms of our everyday lives? And how do you reconcile this that Apple is bigger than the entire UK stock market, and same thing for Nvidia and Microsoft?
Well, the real answer for any prudent long-term investor is that it is what it is. I mean, I'm just thinking while you were talking there, I think I'm physically touching or within arm's length of 8 related products to even though those top three, Apple, Nvidia, Microsoft, right, that I even know about. I'm probably within arm's length of thousands of them, right? All the processing chips in our computer. And so it's just a byproduct of where the inevitable ebbs and flows are. And we're in this again development where we've turned into a digital economy. What was the GEs, the Fords, the GMs of the world is now these tech titans. And it in all likelihood, you'd be going against all historical data to say it's always going to be the case. I mean, who knows? Technology might continue to dominate, but the names will likely change. And the other thing here too is again the scare tactic. And remember, newspapers, websites, they care about you clicking on stuff, right? And the real big numbers too. And just reinforce, the United States is just, United States just geographically, exclude a couple of these countries, China and India, we're almost, just geographically the size of all these combined too. And so keep that in mind when people talk about, yes, I'm not discounting the challenges with our debt or spending. They all be under control, but oftentimes manipulated just by the size of this extraordinary place that you and I happen to call home, Charlie. But again, just more so, I was thinking about that. How many products anyone here, you or I, can physically touch right now, physically touch, or actually in our pockets attached to these companies? And you say, okay, yeah, that does make sense that they are the behemoths that they are right now.
Yeah, that's the difference, I think, between now and back in the day when other big companies were dominant. They weren't as integral to our everyday lives. I asked John Hagenson this when he was on last month, but I'll ask you, Jamie, which of these seven to you really you could you not live without in terms of the products and in terms of your personal life or work life? Which of these would be most critical to you?
Uh, of all the things on here right now, Charlie,
Yeah.
I'd prefer to maintain Australia. I've never been there, so I want to keep that. No, I could go without any of them. I actually don't. I don't know. Maybe I'm just old enough or old fashioned enough that technology doesn't drive me. I'd prefer to hang out with my family and watch Chiefs games with friends. And so, but I don't, maybe Nvidia would stop me from doing my job that pays my paycheck the most. But um, you know, no real
You're
answer
good.
there. I
You're good
they'll
without your iPhone. You're good. You're good without Google and all the YouTube and search and I guess Amazon was the big one for John where he was saying, with just kids every day they're getting packages. It's just made his life so much easier. And I kind of agreed with him there on the personal side and then work side, just being a Excel power user, Microsoft Office, that would be a tough one. But to your point, there's substitutes for all of these things. It's just we do literally use these things all day,
Absolutely.
every
They're
day.
ubiquitous. That's why they
Yeah.
dominate. But we'd find a way without them. We always have and always will.
Okay. With that in mind, if you're looking at your portfolio early 2025 here, reach out to us today at Creative Planning. Get a free wealth path analysis. Go to creativeplanning.com/Charlie. We're going to take a look at your portfolio, your investment plan, making sure you're on the right path for this year. And we'll also take a look at your tax situation. We have many CPAs at Creative Planning. We do tax returns as well. Here we'll be doing tens of thousands of them in the next few months. So make sure that's integrated with your investment plan and your portfolio. We do that at Creative Planning and get an insurance and estate planning review, making sure your assets are protected and you have an estate plan that you're happy with. So reach out to us today. We're in all 50 states. We likely have a location right near you, over 325 billion in assets under management and advisement. And we're here to help. Go to creativeplanning.com/Charlie. Okay, number 4 here, Jamie. What will the deficit be in a year? You don't have to give me a number. Is it going to be higher or lower than 2 trillion? I don't want a non-answer here. I just want a higher or lower than 2 trillion. I'll start out. I'm going to say optimistically it will be lower than 2 trillion.
Well, there's a lot of chatter to make it lower, right? And so
Will they come through though?
you never know. I mean, but yeah, the point is there's a lot of headlines around it right now, and there is bipartisan support for understanding that things can be there. So I'd say, yeah, I hope it's going to go lower, but more so, I hope for my children's sake that we just don't continue to burden future generations with, you know, writing checks that we're never going to have to cash, right? That's what happened to Big Auto, right? The people who ran those companies, right? And the people that ran the unions, right? They made agreements that none of them were ever going to have to deal with. It's the same thing here. And, hopefully we'll trend in the right direction. People are talking about it, but usually when everyone starts chattering, unfortunately, the opposite oftentimes happens.
So when you get in the weeds, we're at 6.9 trillion in terms of spending. We got about 4.9 trillion in tax revenue coming in. And if people want to know how do we get to this place of 36 trillion in debt? Well, we've increased spending far more than the tax revenue has increased. Tax revenue is up 60%, Jamie, in the last 10 years, which I think would surprise a lot of people that we're bringing in that much more. But spending has gone up well over 90%. And when you compound that, what that means over the last decade is you're going from 18 trillion in debt to 36 trillion. So we've doubled the national debt in the last 10 years, which we know is unsustainable if we want to keep things the status quo going well, and we don't want to have a debt crisis in the future, all the rest of it. But the big question for this year is how much of that 6.9 trillion is actually going to be cut. I have no doubt, Jamie, and they've already identified it. And like you said, it seems to be bipartisan, some in terms of everyone wants to cut something somewhere. But when you get in the weeds and you actually have to pass this stuff through Congress, through the Senate, well, then you have to have the situation where you're convincing that congressman, convincing that senator to really think about the long term and not just the short term of them getting reelected. Because if they're taking away this pet project that they have, or they're promising money for their constituents, any number of things, well, that's hard to convince people to do when their livelihood kind of depends on it. So that'll be the fascinating thing. I think that they'll identify many things. How much will they be able to cut remains to be seen, but I would hope at least a trillion in terms of spending cuts to kind of bring it back to a more normalized level. And that 36 trillion, Jamie, this is hard for people to understand. I don't think that's ever going down. It's really that you want to slow the growth of it and let the economy kind of catch up is kind of
Yeah.
the more realistic way, I think, of approaching it. I don't think there's any scenario where we see this chart flip and we're running
Yeah.
surpluses for a number of years. Wishful thinking, but I don't think that's happening anytime soon.
Wasn't that long ago we ran a momentary surplus, so you never can tell. But you're right. The issue is everyone agrees that there's too many inefficiencies and things need to be cut. But as long as we're cutting your stuff, Charlie, and we're not cutting my stuff, right? And
Absolutely.
and so that's the case, and all these things that were designed never to be permanent. Even Social Security, and you think of how much of a component of that this is. That was put in place to during the Great Depression, and there was no social safety net, right? People were starving to death, especially those that couldn't go out and work or support themselves, like the elderly. Well, it's designed that they picked 65 because the average age at that point was, the average person lived to be about 67 years old. So yeah, give them 2 years to enjoy it. But we don't all work in coal mines and smoke 2 packs of cigarettes a day anymore. But like it hasn't really been modified that much. And so I'm hoping we just come into a state. So we have to realize that there's always a lot of disparate interest, but just creating more accountability and understanding where stuff goes. Hopefully, that within itself, that's what we pride ourselves on at creative planning, right? We don't have a lot of layer after layer after layer of bureaucracy
Yep.
like a lot of corporate America. And so just creating more accountability. So people that actually have to explain and justify and actually move forward initiatives that they're blessed to have, you know, um, uh, resources for. hopefully that can be a positive thing.
So you're saying the government should try to be more efficient and run things more like a business. And what some people have suggested is go to the zero-based budgeting approach, which is instead of saying automatically they're going to put 3, 4, 5, 6% increases on last year's number, you go back to square one and say, what do we really need for this department? Things like Social Security, I think that's the biggest line item. It's, around 1.5 trillion of this. None of that's going to be cut. No one's even talking about that. It's the other
Mm.
stuff, defense, education, all, which have many layers, right, and many different things. And is there more efficient way to do various things? I don't think there's any disagreement that there is. No, I don't think anyone's arguing the government's doing things the most efficient way possible. The question is, how do you go from a very inefficient system to something more efficient with people pushing back against that, right? It's easier to do in the private sector and in companies where their goal is to maximize profits, right? So that they're still around. The government has often the opposite goal, which is to keep things going, and they'll do that by minimizing profits in this case, right? Because they're growing the government by borrowing from the future to spend more money today. So it's a really uh, it's a contrast that's so enormous that I think it's going to take time, and it's going to take the American people really demanding that their government is run more like a business, for people to say, well, we're sending you all of this money, you should be better stewards of it, essentially.
Yeah, yeah, it's different than the private sector, but again, a little bit more accountability, a little bit more awareness of where things are going. Avoiding Leviathan black holes. We'll see if we can make progress there. Like, yeah, we might have with the new administration some pretty draconian moves right out of the gates, right? Who knows? It might work, it might not, it might happen, it might not. But almost like us, like myself, trying to be a little bit healthier in the new year, right? It's not some massive deviation. It's just the trend line, right? Trying to do things incrementally better instead of incrementally worse. That's usually the most successful path, but we'll see. Uh, Oftentimes, again, we got where we are because we weren't usually taking the most successful path, and so we'd be discounting things if we think they're going to start doing that now. Again, that there's bipartisan blame to go around. That's not no one party there, but we'll see. And again, hopefully this trend line will not continue because
I
again
think,
that is a concern for someone that has three young kids like myself.
yeah, I think we'll find out very quickly, right, how serious they are about tackling this. That will it come up in the first 90 days, essentially? Because if it doesn't, then if that isn't a priority, right off the bat, then it would mean to me that it's not, the status quo continues, not likely to change. Okay, so we'll come back. Both of us saying deficit's going to be lower a year from now. Hopefully, that's the case. We'll come back a year from now and see if that's correct. I want to talk about bonds here, Jamie. This is a question I get every week from people asking about this chart, and really the fact that stocks and bonds have been moving together like never before. I'm showing you the rolling 3-year correlation between the S&P 500 and the Bloomberg Ag Bond Index over the last 3 years, 0.73. That just simply means if you look at monthly returns, when stocks are up, bonds tend to be up. When stocks are down, bond tends to be down over the past 3 years more than ever before. And we know the reason for this, Jamie. It's because the big fear over the past few years, especially in 2022, but even 2023 and even last year, big fear during corrections is inflation. And when inflation is the biggest fear that's going on in the market, well, during corrections, you have interest rates rising because of that inflation fear, and that obviously pushes bonds down, and stocks, which historically have pretty much a zero correlation to interest rates. Well, during the past few years, they've been much more correlated. But the big question, Jamie, is of course not what has happened over the past 3 years. Is this indicative of what's going to happen in the future? Which is essentially asking, are correlations predictive of what's going to happen going forward here?
Well, I think it is indicative of the future, but unfortunately, I think it's really indicative of what investors are going to do, as they've done time and time again, and typically emotionally make the exact wrong decision at the exact wrong time. By some measurements, we've been, like I said, the worst period for bonds ever in some capacities. And we're essentially in like a 4-year bear market for bonds. Think if that was the case right now, Charlie, if it was for
Yeah,
stocks, right? People would be running around like their hair's on fire. Right now,
absolutely.
again, it's also for moving people in the private credit, which we've always had a very high conviction. We've been investing in our clients, the private market space for years. People are running to it right now for all the wrong reasons. It has no duration. It can spike. Rates can move higher when inflation goes up. So, instead of being down 10, 11, 12% in 2022, it was up 6, 7, 8, 9%. Didn't do anything special. It just did what it was supposed to do based upon market conditions, what they gave. And unfortunately, people are jumping in that for the wrong reasons. People that had these bond allocations are maybe disappointed, upset that they've had poor returns. They're moving away from them. But again, the key here and at the core of creative planning, why do you have these things there for the first place? It's like accountability with the government. Just tell me why, and then back into if you should have it.
Yeah. So why do you
So
own bonds? We know
so
stocks are for growth, right? And to keep pace,
yeah,
outpace inflation. Why do you own bonds?
you own bonds to fulfill withdrawal needs you have in the short to midterm. And the idea is, so if the markets dislocate, which they inevitably do, right? 1 out of 4 years, the markets go down. Like I said, twice in the last 15 years, markets have gone down 30% or more, but we have these great all-time highs. It is the price of admissions, but you don't, it just occurs. It's ever moving forward, but it's ever up, it's ever down. You don't want to have to make wild oscillations to the life you need to live based upon market conditions of the moment. And so if you're not working, you need to live off this. You need to have several years, 5 years worth of withdrawal needs. So hey, the market can keep going down for several years. I can still do what I want to do, right? I'm not hamstrung because of that. And I know it's the inevitable dynamics. The worst thing, Charlie, that again, these general rules of thumb with the market, that creative planning has our entire design is to destroy these failed narratives, right? You're rewarded more over the long run for being an owner versus being a lender. In the short run, you don't know, but the data says that's overwhelmingly supportive over the long run. Arbitrarily, like I mentioned with housing, the challenge are people, it's one of the two places people have money, right? Their house and their 401k. And they're both there because they're forced savings plan. People are investing when they don't even think they're investing. So a lot of people that don't even think they're investing with 401ks, they're probably defaulted in like a target date. And again, let's say you're 65 years old, average target date at that age maybe has 60% bonds in it, just because, right? Just because you're
Hmm.
65 years old. So 60, and then just based on what Mr. Market's given us recently, more than half of your portfolio has earned nothing, has actually earned negative returns in all likelihood over the last couple of years. Just these general rule of thumbs are foolish. That should, with your money, it shouldn't be a general rule of thumb. It has to be based on your particular needs, your particular circumstances,
Yeah.
and why you need it to withdraw. That's why you have bonds, to have that dynamic to support you, not to support what inflation is, what interest rates are, what the stock market's done relatively speaking recently. Do it because of you, not because of some outdated draconian concept says you should have a bunch of it.
Right. And to me, Jamie, and I know we talk about correlations a lot and it's a wonky term, but if I look at this chart here, my takeaway is that it doesn't seem to be predictive whatsoever, right? It's been high in the past and then it's
Oh,
come down. It's been low in the past and it comes up. It seems to be mean reverting. Doesn't mean it's going to happen at this point. But I
yeah.
would not be using this as it was a way to say stocks and bonds are always going to have this high correlation. And in fact, I would argue that the correlation is likely to be much lower in the next few years because if you think inflation won't be as big of a problem, hopefully it won't be, then that concern gets taken away. And if there's an economic downturn at some point, well, then more likely you have this relationship go back to zero or maybe even negative, right? Because then you have a situation where when the market is falling, interest rates are falling because growth and inflation expectations are falling. But if we look at the last 7 years, Jamie, and we just look at a 60-40, it's been pretty good, right? 8.8%. But you dig into that portfolio, and almost all of that return is coming from the stock side, 13.8% annualized from the S&P, 1% annualized from the bond market. And then I say to myself, well, what about this last 7 years? First of all, was that very low return predictive last 7 years ago? And the answer to that would be no, we didn't think it would be 1%, but it was a pretty good argument to say it was going to be pretty low because interest rates were very low if we look 7 years ago, right? If we're looking at around 2% yield 7 years ago, and now we're looking at much higher yields today. In fact, we ended 2024 at 4.58%. That was the highest year-ending 10-year yield for the Treasury yield since December 2006. So if we're looking at the bond market, Jamie, anything can happen in the short run. It's interest rate changes dictate everything. But if we're looking out 7 years, and I'm looking at this chart here that I put together, 97% correlation between the starting 10-year yield and what bonds do on average over the next 7 years. That's a pretty high, remarkably high correlation. So the odds of you getting 4 to 5% in bonds over the next 7 years, pretty good today. So that I wouldn't extrapolate that 1% return by any means, and definitely don't extrapolate the negative return we've seen over the last 5 years in the bond market. Not likely to be repeated because we were coming from these all-time lows in yields, right? Where the 10-year was below 1%. It hit a low of 30 basis points during one point in 2020. Does
Yeah.
that make sense to you?
Yeah, and if it was justified to have bonds in your portfolio before we had this difficult time period, it should be if you're doing it right. It's justified to maintain them now, right? And you've weathered the storm, right? You've moved past it. It went from 1%, to 5%, and now again,
Yeah.
now yields moving forward are higher. If interest rates go down, they'll be even higher for traditional public market bonds. But go back one or two, if you don't mind,
Yeah.
make sure, yeah, this one. And so I think what is Winston Churchill that said, guys like us, Charlie White, we use graphs like drunks use lampposts, right? More for support than illumination.
I
And
like
so
that.
it's all about the X and Y axes. And again, what we're showing right now, look at like that period. Let's say we were doing this in 2009,
Yeah.
2011, right?
Right
You
there.
could have done the
Yeah.
exact same thing and say, look, we told bonds have been driving everything, right? And here's why you should be putting all your money in bonds right now, right? The new world order, the new normal, right? Some of the quote
Yeah.
unquote smartest people in the world monikered that one, and they were just wrong. And so it
Yeah.
all depends on, if you zoom in any small time period, like even this most recent delta, what it's like a 10-year time period. You can make things say whatever you want them to say, but more so do what's right for you. Have bonds to fulfill your withdrawal needs in the public markets, and be rewarded for being an owner versus a lender over the long run. Short run, total coin flip. Long run, it's math. But to Charlie's point now, 5% approximately, it's a lot better than decile one that we were in for quite some time.
Yeah.
And so think of it like that as a positive note in regards to bond holdings.
Yeah, and as you said, stocks go down, roughly one every 4 years. It's not orderly, so we don't know when it's coming. But if we look historically, before 2022, bonds did pretty well in these other down years for the stock market, going back to the 1970s. And again, the bond market is positioned better today much better today than where it was entering 2022, which simply means, and I don't want to get into bond math, but the higher the starting yield, the less sensitive you are to further increases in interest rates. So if there's another, let's say the 10-year goes up to 5.5%, that won't hit you as much in terms of being in a bond investor because you have this higher coupon than when interest rates went from 0 to 1%. You're hit much harder. Okay, we got two more things I want to talk about real quick here. A book recommendation. Give me the 1 minute on the Square and the Tower here, Jamie.
Yeah, I was lucky enough to take a little bit of time off with the family over the holidays, and so I was perusing, Yeah, I actually went into a bookstore. Unlike our colleague that just wants to order it online, I still like walking around. The kids were doing, kids had some sporting event or practice or something. So I went in there and I saw this one. Thought it was really interesting. It's just kind of the evolution of really just communication and how we communicate and the power around those that can effectively communicate, from either the square or the tower. So really interesting kind of economic history of um, of how we communicate and how that communication is powerful and kind of the indirect spheres of it. But disclaimer: this is someone that has an advanced degree by some dynamics in economic history. So I happen to particularly like this stuff. So it would put my wife to sleep instantaneously. But very, very interesting for those that want to understand that the evolution of the power through communication and networking um, through the evolution of man.
Okay, cool. Well, I'm gonna give a
What
book
about
that's
you?
good for everybody. You don't need an advanced degree. It's just a great story. I don't know if you've seen the movie Alive of the rugby team from Uruguay, and their plane crashes, and just an amazing, amazing story. This was written, I think, 20 years after it by one of the survivors, Nando Paredo, and just an incredible firsthand account of what happened. And I actually liked it better than Alive. And I don't want to give too much away if you don't know the story. So just go out and get Miracle in the Andes. Awesome, awesome book.
Yeah.
Jamie, two more things I want to touch on here. NFL playoff predictions. Uh, Last time we spoke, you were taking the Chiefs in the Super Bowl. Do you still like the Chiefs today? They're playing the Texans. I picked the Bills in our last discussion. I'm still taking the Bills. They got a tough game against the Ravens. What do you think here?
I'll like the Chiefs every day for the rest of my life, Charlie. No matter how much the data says is wrong. That's the beauty of this dynamic. Even though actually we are now able to invest in sports franchises for our clients. Really interesting, regulations change and we're starting to do that. But okay, my subjective opinion aside, you go with the team that has the best player combined with the best coach. And I think that still makes you circle back to my beloved Kansas City Chiefs.
Who would you
So,
like to see the Chiefs play in the Super Bowl? Yeah, you had your choice.
I think like a lot of America, like the Lions, but you know what? I am 100% rooting for the Los Angeles Rams because that city's population and
Yeah.
fan base deserves a little something to distract them from what they're dealing with. And so I'm definitely going with the Rams for just as subjective reasons as the
Okay.
Chiefs. And on that, for all of our colleagues who are dealing with it, and anyone listening to this right now is dealing with that. Very sorry, and you're in our thoughts. What about you
Excellent.
though?
Okay. So hopefully for
So
you,
besides the
the
Chiefs, I know
Chiefs.
you. I know you're a
I'm a
big
New
Taylor Swift
Yorker,
fan. Big
so
Taylor Swift
yeah.
fan. So you're going Chiefs.
Yeah, exactly. I'm a New Yorker, and the Bills are in New York. They're actually the only team that actually plays in New York. The Jets and the Giants play in New Jersey. So I'm going with the Bills here. I'm sticking with it. I would like to see the Bills win their first Super Bowl. I think Josh Allen is just having a career year. He's a good guy, and I'm hoping that the Bills get it done. But it's going to be a tough game against the Ravens. You can see the spread there, very close. These other spreads much higher. The Chiefs expected to win. The Lions expected to win. The Eagles expected to win. The Bills, Ravens, really a toss up. But we'll revisit it. The Lions are currently favored to win the Super Bowl. Then you have the Chiefs, Ravens, Eagles, Bills, Rams, Commanders, Texans. But anything can happen. There's a lot of parity in the NFL this year, which is good to see. It's going to be some fun games. Okay, Jamie, let's end as we always do, something positive. I got two things here. Number one, real wages. And I'm talking about this every month because this is the biggest factor helping the economy. U.S. consumer spending, 70% of the economy, and wages have been outpacing inflation on a year-over-year basis now for 20 straight months. This is great news for the American consumer, the American worker. Hopefully, this continues. And then we have small business optimism, highest since October 2018. Saw this stat from NFIB. The net percentage of owners expecting the economy to improve rose to 52%, the highest since 1983. Now, this is just a survey, of course, Jamie, but a lot of optimism in small businesses these days. I think a big part of this, if you dig into the numbers, was the uncertainty about tax policy, and now it seems very
Mhm.
unlikely that we'll see higher taxes in the
I,
next 2 years.
I'm just surprised 52%, the highest since 1983. So majority of owners have been slightly negative. You know,
It's a
everything
net
I
percentage, so I don't know how they calculate. I don't know if that's
yeah
52. I don't think it's like out of 100, but
yeah.
if it is, then good point.
But it is nice to see wage. Again, keep in mind it is great the wage growth, real wage growth. Oftentimes you only just hear one side of the ledger, like eggs going up, bacon going up, but they
Yeah,
never talk about wages going up more than bacon going up. So you can afford more bacon, even though it stinks. And so it's great that hopefully have more people have more money in their pocket and help do the right thing. And it's great to be optimistic because every empirical data point says, optimism and having a positive attitude is helpful in business, in life, in personal health, and so it's great to see that trending positively.
yeah. If you're gonna pick one side, pick the bright side. And as a long-term investor, you have to kind of pick that side. You have to assume that 20 years from now things are going to be better than today, or else you wouldn't invest, right, in the first place. So, and as you said, it's better for your well-being all along. So why not pick that as your bias? Doesn't mean you can't be skeptical, but have a positive long-term outlook. Jamie, awesome show. Thank you so much for joining us on the Weekend Charts once again. Always great to have you. And have a great weekend. Go Bills, go Chiefs, go Rams, and we'll see what happens. If you're watching this on YouTube, hit that subscribe button for more content just like it, and we'll see you next time on the Weekend Charts.